Hi, it's David here. Today I want to talk to you about the recapitalization of your investment funds. What do I mean by that? Well, when you invest in something, an asset, any kind of asset, and you have all of your money in that asset, in other words, there's no leverage, you haven't financed that asset. It's a free and clear asset, and it's producing you some kind of return on investment, a cash flow, royalties, dividends, interest, something that's great, but you've always got to be looking at what is my real return on that equity. In other words, the value of that asset. Let's get focused more on real estate, which is what I like. So let's say you have a free and clear property. Maybe you originally financed the property. You bought it with some financing. You leveraged to acquire the property. It's commonly done in real estate. That's a great way to build one's estate through proper use of leverage. But you've paid it off now. You've held it for 5, 10, maybe 15 years, and you've paid it off, and now it's a free and clear asset. Could be a commercial building, could be a rental property, doesn't matter. At that point in time, you've got to look and say, well, what is my real rate of return on that equity? In other words, what is my net return, net cash flow per year divided by the actual value of that property, that equity. The property value has probably gone up over 5, 10, or 15 years, as has probably the cash flow, and that's good. That's what real estate does. But at some point, it may make sense to recapitalize or refinance or take cash back out of that equity of the property and put it back to use again, re-leverage it again. I'm not saying it's always the case, but many times it's the case because leaving money that is, or equity that is lazy, not working hard for you, is not the way to compound it and grow faster. Now, if you've got all you need, if you're comfortable, if you're happy with the returns on the equity that you have, and you feel like that's all you need going forward, don't go back into debt. But debt can be your friend if you're trying to make up for lost time, if you're trying to build your holdings faster. Here's an example. Got a great friend of mine. He's a great dentist, and he's got involved with Freedom Founders and made some great investments. In fact, some of his investments have increased over the last 5 or 6 years by multiples because the real estate market's been going up. He's done very, very well. Well, his investment lending period is coming up now where he's going to get his money back or can have his money back. In other words, the principal comes back along with all the returns he's already made. And now he's going to have that capital back in his hands again because that's where he and his wife feel safe. Okay, we kind of want our money back in our hands again. Well, why? Why is that? Well, it's that safety factor. It's risk aversion. It's like, okay, we put our money out there, we made good money, but let's get it back in our hands again now. Well, this doctor's still working. Yeah, he's still working hard in his late 60s. Now, if that's just what he loves to do and there's no problem with that, then he's okay. But I would say, why not take the fruits of your labor, that capital that you worked so hard for, and get it back out in the market and work it again? What are you going to do with it now? Put it in the bank at less than 1%? Put it in bonds at less than 2.5%? Where are you going to put it today? If you've already had great success in an asset class, why wouldn't you keep it working at 8, 10, 12% and greatly multiply your returns? That's what the velocity of money is all about, turning that money. That's how you build momentum, how you build equity, net worth, and therefore cash flow much, much faster than letting your equity sit idle. Dead equity is what I call that. You don't want that if you're trying to grow. In fact, I don't think you want a lot of dead equity even when you're secure, because inflation in the future is going to eat up a lot of those cash flow returns. And if we don't keep pace with inflation, then what we have today can be worth a lot less in the years to come. All right, that's my tip for today. Always look at your recapitalization and your return on equity as you invest going forward. And remember, always stay focused on your freedom. I'll see you next time.